Rent versus buy. Why your house is a liability, not an asset. There's a script handed down from our parents, preached by grandparents, and reinforced by every real estate agent on a bus bench. It's the American dream, the ultimate marker of adulthood, and the supposed golden ticket to middle-class wealth. The script says, rent is throwing money away. You're paying your landlord's mortgage instead of your own. Buying a house is the best investment you'll ever make. We internalize this doctrine until it becomes part of our identity. We feel deep, visceral shame when we're still renting at 30, as if we've failed to launch. We panic buy homes we can barely afford, stretching our debt-to-income ratios to the breaking point. We're convinced we're making a smart financial decision simply because we signed a deed. But I'm here to tell you that for millions of people in the modern economy, this script is a lie. The math has changed, the market has changed. The uncomfortable truth is that for many of you watching this, your house is not an asset. It's a liability, a massive leverage-fueled consumption purchase masquerading as an investment. I'm Boris, and I spend way too much time running the numbers the real estate industry hopes you never see. Today, we're dismantling the rent versus buy myth piece by piece. We're exposing the unrecoverable costs of homeownership, the money you throw away that's mathematically identical to rent. We're calculating the price-to-rent ratio, the single most important metric for deciding where to live. And I'm showing you how a disciplined renter who invests the difference can often end up with higher net worth, more freedom, and less stress than the homeowner chained to a 30-year mortgage. Redefining throwing money away. To understand why buying isn't always better, we have to redefine what throwing money away actually means. When you rent, you pay a monthly fee for a roof over your head. That money is gone. This is clear. But when you buy a house, you're told that your monthly payment is savings or equity. This is false, especially in the early years. A massive portion of your monthly housing cost as an owner is also thrown away. It's money that never comes back to you, money that builds zero equity. We call these the unrecoverable costs. Let's break them down because they're silent wealth killers. First, the cost of capital, mortgage interest. In the first few years of a 30-year mortgage, nearly 70 to 80% of your monthly payment goes straight to the bank as interest. You aren't paying yourself, you're renting money from the bank. If you look at an amortization schedule, it's terrifying. You might pay $3,000 monthly, and only $400 actually reduces your debt. The rest is vapor, gone forever. Second, property taxes. Property taxes are a perpetual rent you pay to the government for the privilege of staying on your own land. In high-tax states, this alone can equal a modest rent payment. Third, maintenance. The rule of thumb says maintenance will cost 1 to 2% of the home's value every single year. This isn't just renovations. It's the unsexy stuff like water heaters, roof patches, and pest control. Fourth, homeowner's insurance. This is a mandatory expense that provides no equity. Fifth, transaction costs. The massive costs of buying and selling can eat up to 10% of the asset's value. When you add all these up, interest, taxes, maintenance, insurance, and fees, you often find that the unrecoverable cost of owning a home is nearly identical to, or even higher than, the cost of renting a similar property. You aren't building wealth, you're just paying a different landlord, one comprised of the bank, the state, and the hardware store. The price-to-rent ratio. The math of this decision usually comes down to one critical number, the price-to-rent ratio. This is essentially the PE ratio of the housing market. You calculate it by taking the price of a home and dividing it by the annual cost to rent a home. Similar home. If a house costs $500,000 and rents for $2,000 monthly, $24,000 yearly, the ratio is roughly 20. Historically, a ratio below 15 suggests it's better to buy. A ratio above 20 suggests it's arguably better to rent. In many major cities today, Toronto, San Francisco, New York, Sydney, ratios are pushing 25, 30, or even higher. When the ratio is that high, the math screams at you to rent. Why? Because the cost of capital on that massive purchase price far exceeds the cost of rent. By renting, you're effectively shorting the housing market. You're living in a $1 million asset for a fraction of the cost it would take to finance it. You're letting the landlord subsidize your lifestyle while they take on the risk of the boiler breaking, the foundation cracking, or the market crashing. You're consuming housing services at a discount while the owner speculates on appreciation that may or may not happen. The opportunity cost of the down payment. But the most dangerous trap of homeownership is the opportunity cost of the down payment. This is the invisible wealth killer that nobody talks about at dinner parties. To buy that $500,000 home, you likely need to put down $100,000, 20%. That's $100,000 of cash now locked in a wall. It's dead equity. It produces no cash flow, cannot be used to buy groceries, cannot be rebalanced. It's trapped. If you had taken that $100,000 and invested it in the S&P 500, which historically returns 10%, it would mathematically double roughly every 7 years. By locking it in a house, you're placing a massive bet that your single, specific, local real estate market will outperform the diverse global stock market. A bet that, historically, real estate loses. Robert Shiller, the Nobel Prize-winning economist, proved that over the last century, real home prices have barely outpaced inflation. The massive gains people talk about are usually just inflation illusions or leveraged luck in specific bubble markets during specific decades. By renting and investing that $100,000 down payment, plus the monthly difference between rent and ownership costs into the stock market, you maintain liquidity, diversity, and a higher expected rate of return. This is the rent and invest the difference strategy, and for disciplined people, it's a wealth accelerant. It turns you from a house-rich, cash-poor prisoner into a liquid millionaire. Liquidity and mobility, the hidden asset. We also have to talk about liquidity and mobility, which are undervalued assets in the modern world. Your house is an anchor. In a rapidly changing economy, the ability to move for a better job, lower cost of living, or better lifestyle is a massive financial asset. If you get a job offer in another city that pays $50,000 more, the renter can pack up and leave in 30 days with minimal friction. The homeowner is trapped. They have to sell the house, pay 6% in agent fees, pay closing costs, stage the home, and potentially sell at a loss if the market is down. The transaction costs of selling a home can wipe out years of accumulated equity in a single afternoon. By buying, you're essentially shorting your own mobility. You're betting that your current location will be the best place for you for the next 7 to 10 years. If you're wrong, the exit fee is brutal. Renting buys you optionality, and in a volatile world, optionality has premium value. But rent goes up, my mortgage is fixed. Now I hear the objection already, the one everyone yells in the comments. But Boris, rent goes up, my mortgage is fixed. This is true, and it's the single strongest argument for buying. A fixed-rate mortgage is indeed a hedge against inflation. But remember, while the mortgage is fixed, nothing else is. Property taxes go up constantly as municipalities need more revenue. Insurance premiums are skyrocketing due to climate risks. The cost of labor and materials to fix your roof goes up with inflation. You're not immune to inflation, you're just exposed to it in different ways. And while rent does go up, so does the stock market. If your investment portfolio, funded by savings from renting, grows at 7 to 10% yearly, it will likely outpace the 3% annual increase in rent. You're using your appreciating assets to pay for your lifestyle rather than using your lifestyle, your house, as your only asset. The gap between your investment returns and rent increases is often where the renter wins. The lifestyle cost of home ownership. There's also a profound lifestyle element that gets ignored in the spreadsheets. Home ownership is a part-time job. It's weekends spent at Home Depot instead of with your friends. It's the stress of hearing a strange noise in the basement and knowing you're the one who has to pay for it. It's the mental load of managing a deteriorating physical asset. When you rent, you're outsourcing that stress. You're buying time. If the dishwasher breaks, you call a number and it gets fixed. That time freedom has value. If you use those Saturday mornings to learn a new skill, start a side hustle, or just relax and recharge, you might find that renting actually increases your income potential because you aren't distracted by house maintenance. You're trading the pride of ownership for the luxury of freedom. Many people buy a house thinking it will give them stability, only to find it gives them anxiety. When buying makes sense. I'm not saying you should never buy a house, Buying makes sense in specific scenarios. If you're settling down for 10+ years, if you value the ability to renovate and customize more than you value liquidity, and if the price-to-rent ratio in your area actually favors it. But don't buy because you think it's a mandatory step to wealth. Don't buy because you're afraid of throwing money away on rent while ignoring the money you throw away on interest and taxes. A house is a consumption choice, like a fancy car or a nice suit. It's a place to live, not a guaranteed retirement plan. If you treat your primary residence as your primary investment, you're creating a highly concentrated, illiquid, expensive portfolio that's one natural disaster or neighborhood decline away from financial ruin. The path to real wealth. The path to wealth is not about owning a deed. It's about owning income-producing assets, stocks, bonds, businesses. These are assets that pay you. A house is an asset that you pay. Don't let the cultural script bully you into a bad investment. Run the numbers, check the ratio, look at the unrecoverable costs, and if the math says rent, then rent with pride. Invest the difference, build your liquid empire, and let the landlord worry about the roof. Hit like if this video made you rethink the American dream. Subscribe to Boris Finance for more ways to hack the system, ignore the pressure, and build wealth on your own terms. I'll see you in the next one.